In this session, we are looking at prepaid expenses. Now, the true definition of a prepaid expense is an expense that we've paid in advance. A prime example of this is when we pay our insurance. Say you're going to insure a motor vehicle for your business. You normally pay your motor vehicle 12 months in advance. You pay your insurance annually. So in your resource book, I'm looking on page number 77. And the example that we're looking at is Inez Essential Oils and Prepaid Expenses. And it says in the scenario, assume that a premium of $10,000 plus 1,000 GST is paid on the 1st of April for fire insurance for 12 months. The payment was recorded by debiting the expense account. At the end of the accounting period, it is the 30th of June 2019, and balance day adjustments will be made. And what you need to do is you need to do the general journal entries to record the adjustment and its reversal, and the general ledger accounts and the extracts from the income statements. So just at the start of the question, it says there that on the 1st of April, so it would be the 1st of the 4th, 2019, we would have paid for this insurance. Now you've paid cash for the insurance, so you would have the insurance amount of $10,000. See, I've got to add a zero to that. That had GST paid of $1,000, and you paid the money out of the bank being $11,000. Now you would say here in your narration, insurance paid for 12 months. Okay, I'm going to put my little narration in red so you can see that. So that is why we have a balance in our insurance account of $10,000. But our financial year ends in June. So that means the insurance for this year is only for April, May, and June. So in other words, we've only paid and used 3 months of the insurance. That means there's 7 months of the insurance that we still haven't used and should not be recorded as an expense for this year. The book does give you a little timeline, and it shows you the timeline. I just want to show you how I would work it out. So my workings. Okay, so to work out, well, how much has the insurance been for the 1st April, May, and June, the first 3 months? We would just say equals 10,000 multiplied by 3 divided by 12. So for this part of the year that we are talking about now, our insurance expense has been 2,500. 7 months, it's not 7 months, is it? The remaining time, the 9 months of the year, our insurance still hasn't happened. So if we say equals 10,000 multiplied by 9 divided by 12, we're going to get 7,500. This 7,500 is for next year, next year's insurance. This 2,500 was for this financial year. So that means we've got to take $7,500 out of our insurance. So when we take it out of our insurance, we take it out on the credit side. So we're going to say 7,500 comes out of insurance on the credit side. Where are we going to put it? We're going to put it in a new account that we create, and this new account is called prepaid insurance. And prepaid insurance is an asset to us. The reason why it's an asset is because we haven't yet used the insurance, so we can claim this money back should we need to. So the $7,500 goes into the prepaid insurance as an asset. So we can now post these figures to the actual ledger. So 7,500 goes into prepaid insurance. The name of the account on the other side is insurance. All of this is happening on balance day, which is the last day of the financial year. Now we're going to go into the insurance account and we're going to take $7,500 out of the insurance account. Where are we putting that $7,500? In other words, what's the name of the account on the other side of the equation that's being affected? And it is your prepaid insurance. Okay. Now remember, as per the previous example, this section here is not in your book, but I'm just explaining to you how it happens because it does happen before we do any reversing entries. We're going to balance off our insurance expense account by making sure that we post the amount of the expense for the year to the profit and loss account. So we know the missing figure there is $2,500. That is the expense for insurance that we're going to put into the profit and loss account, and we're going to take it out of the insurance account. So we're going to go into our insurance account and we're going to take out $2,500. Which account are we putting it into? We're putting it into our profit and loss account. Okay. We're now going into our profit and loss account, just like we have said here, and into our profit and loss account, we're putting $2,500. What is the name of the account on the other side of the equation that's being affected by the transaction? Well, that is insurance expense account. Okay, so we now have our insurance expense account reduced to zero. Our prepaid insurance, and our prepaid insurance is an asset account. So we don't close off our asset accounts to the profit and loss account. They stay open. And then we've got, and I'm just going to sort out my borders here. I don't like it with an arbitrary line on the side there. We have got our profit and loss account is going to record that our insurance expense for the year was $2,500, which is perfectly correct because we've still got 7 months of next financial year that we will use next year. So that all happens on balance day. Okay, so on that same day, on balance day, we would go and into our extract of our income statement, we would then say the insurance for the year is $2,500. Okay, this time, instead of having a current liability like the previous example that we used for accrued expenses, we are going to have this as a current asset. And this current asset is a prepaid expense. And I've spelled expense incorrectly. Okay, so our current asset, our prepaid expense, is $7,500. Okay, and that is our prepaid expense. Now we come along to the first of the new financial year, and we need to make sure the very first thing we do is we reverse any form of accruals and prepaids. So we need to make sure that this $7,000 now appears in the insurance expense account because it's part of the expense for the next financial year. So we need to do that by saying, okay, into the insurance account, we're going to put back $7,500. And where are we going to take it from? Well, we're going to take it from the prepaid expense account of $7,500. So we're going to go to post it, and into our insurance expense account, we put $7,500. The date of the transaction is the 1st of the 7th, in other words, the first day of the new financial year. The name of the account on the other side that's being affected by the transaction is prepaid insurance. Now we're going to go into our prepaid insurance, and we're putting the $7,500. The transaction is happening on the 1st of the 7th. So we're going to put the 1st of the 7th. The particulars, in other words, the name of the other account that is being affected by the transaction, is obviously going to be insurance. So now we've reduced this account here to 0. Why? Because we've put it into our insurance expense account so we can start the next year with 7,500 being available to use on our insurance. You can now complete self-test exercise 2 on page number 78.